Hello everyone, welcome to Wealthy Wisdom. In this video, we're going to talk about investing in index funds, S&P 500 explained. If you're new to this channel, do like and subscribe to the channel. You're an average American who is thinking, I know I should be saving for my retirement, but I don't know how. I've heard that investing in the stock market would result in more long-term growth and investment than putting your money under your mattress, in a CD or in a safe investment. Then one day, it occurred to you that maybe you ought to invest in S&P 500 index funds. It probably didn't happen that way. But the point is that you've heard of the S&P 500, you feel you understand what it is and how it will help your portfolio. But you don't know much more about the S&P 500. This video will demonstrate all you need to know about the S&P 500 index. Everything a typical American investor needs to know about investing in an exchange-traded index fund. I will expose for unknown truths regarding S&P 500 index funds that the majority of people, especially the average American, are ignorant of. Due to your extensive knowledge of the S&P 500, you will no longer be able to claim to be a typical American by the end of the film. Although most people are aware of the basics of the S&P 500 index fund, I'd like to offer you with a plethora of extra information, including all you need to know. Okay, let's begin our discussion of the S&P 500 and S&P 500 index funds. The first unknown fact. Things you may not have known about the S&P 500, I'm going to expose a little known fact about the S&P 500 right now. The majority of individuals assume that the S&P 500 reflects 500 companies. True, but it really relates to 505 unique stocks. This is because, despite the fact that the S&P 500 consists of 500 distinct companies, a few of them have several classes of stocks such as Class A, Class B, and Class C, resulting in the S&P 500 having 505 distinct stocks. The S&P 500 index includes 500 of the largest companies in the United States, but not necessarily the top 500. Multiple variables including the company's profitability, trading volume, and market capitalization affect its value. In other words, the value of the company and a number of other features that the average American is disinterested in you may be pondering. I know there is something called the S&P 500 index, but how can I invest in it? How does it work, you may ask? You must make a contribution to the S&P 500 index fund, which will subsequently purchase shares in each of the 500 companies that comprise the S&P 500. One of the most essential things to know when investing in the S&P 500 index is that you cannot outperform the market. You are following the market, which is not necessarily a bad thing given that the market has done well over the last 5, 10, 15, 20, or 50 years. Even though there will be ups and downs along the road, everything will work out in the end. The second unknown fact is, regarding the S&P 500 index, I've had a concern for a very long time, as I'm sure many other average American investors do. You will see that the three distinct companies, IVV, S&P, and VO, all have different prices for the S&P 500. You may ask, why, if they all follow the same index, do they all have different prices? It is immoral for me to purchase shares in a cheaper ETF than another. Is it conceivable that I've been duped? Does the amount of value I get for my money vary based on the one I own? In reality, there is not much of a distinction. Although there are price of differences, $100 investment in any of these ETFs will provide the same return since they all track the S&P 500. The actual performance of the 500 largest companies is now available. IVV is priced at $370.31 per share. VO is priced at $339.16 per share. And SPY is priced at $369.16 per share. However, an investment of $100 in any of these three ETFs will provide the same result. The most significant explanation for the variance in expenses is that they did not all start on the same day. The inception dates of these three ETFs are distinct. Consequently, firms with better potential for development will share a higher share price. Remember that the main difference between these three S&P 500 ETFs is their expense ratio. When dealing with enormous quantities of money, a VO or IVV is the best option. However, if you want to trade SP 500 options, a VO may be more advantageous. If you like this video, don't forget to like and subscribe to the channel. The third unknown fact. The SPDR S&P 500 SPY is not an exchange-traded fund, but rather a unit investment trust that mirrors the S&P 500 index. Possible question: what does that mean? Is it both insignificant and significant? Please accept my apologies for being rather vague. A unit investment trust is structured similarly to an exchange-traded fund or ETF, although in a less active manner. According to the rules, it cannot be an actively managed fund. There are actively managed exchange-traded funds or ETFs. They are rather uncommon. Their regulations primarily make them indexable and passive. The unit investment trust must be passive and based on a predetermined portfolio. Active trading is prohibited. In addition, unit investment trusts have a predetermined end date, which means that by the year 2118, we will undoubtedly have flying cars and microwavable tablets that include a whole meal. In contrast, the unit investment trust known as SPY will be dissolved and liquidated in the year 2118. I assume there is a means to enlarge it, which is nothing extraordinary. Understanding how dividends are managed by unit investment trusts is also crucial. Many S&P 500 firms pay dividends to their shareholders. And if the shareholder is an investment company, the dividend may be promptly reinvested and then paid out quarterly in the future. Due to the fact that companies pay dividends on a flexible schedule throughout the year, the dividends may be swiftly reinvested by the investment firm and then paid on a quarterly basis, with quarterly payments potentially yielding the highest returns. In contrast, the restrictions of a unit investment trust prohibit dividend reinvestment immediately. You must be in cash and hold the cash until the due date. It is conceivable that this may lead to unfavorable results. However, the converse is also true. If the unit investment trust retains the funds and a bear market ensues, the funds may be worth more than if they were promptly reinvested. In the end, it produced outcomes that were comparable for the three businesses. Expense ratios are provided for each of three S&P 500 ETFs. The fee charged by the management organization for administering this investment on your behalf is fairly low. The expense ratio of the SPDR S&P 500 Unit Trust is 0.0945%, therefore $10,000 invested in this product will cost $9.5. It also has the biggest trading volume by a significant margin, and many investors use this strategy to hold S&P 500 options owing to the volume. Additionally, it is the oldest S&P 500 ETF, having been established in 1993. The iShares Core S&P 500 ETF, symbol IVV, is rated second on this list. IVV has an expense-to-revenue ratio. Although IVV has a smaller trading volume than SP, it has a lower cost ratio and greater trading volume than the third ETF we will review. The third index fund is the Vanguard S&P 500 ETF or VO, which has the lowest expense ratio of 0% or $3 for every $10,000 invested, and lowest trading volume of the three index funds. In contrast, the average American investor is worried since these assets should be held for the long term. The fourth unknown fact is the second significant truth regarding the S&P 500 index that most people do not know. All S&P 500 index funds are market capitalization weighted by definition. Even if there are 500 companies and 505 unit stocks, they are not all created equal. Hence, not all 505 stocks are owned equally. The average dual investor represents some of the world's leading firms, including Apple, Microsoft, Amazon, Facebook, Google, Tesla, Berkshire Hathaway, Johnson & Johnson, and JP Morgan Chase. Despite the fact that the index comprises 505 equities, these corporations own between 1% and 6% of it. Alternatively, some of the smallest enterprises manage up to 6% of the market. You may be considering Unigroup Xerox Armor Classes A, C, or News Corporation's Class B. Approximately 0.01% of the index is owned by these companies. If you own the S&P 500 index, you are diversified, but not as much as you may believe. The top 10 holdings of the S&P 500 index are very similar across all types of mutual funds and index funds. You may own around 28.2% of the fund's assets, although the top 10 holdings account for more than 25% of the total. You are an average American who wants to invest in the S&P 500 index. There are 3 unique approaches to investing in the S&P 500 index. Investing in a mutual fund, often known as an indexed mutual fund or index fund, is the first alternative. The second alternative is to invest in an ETF. And the third option is to invest in a unit investment trust. Consider the distinctions between mutual funds, exchange-traded funds, and unit investment trusts for the time being. You may buy shares of a mutual fund at any moment throughout the trading day, but the price you get at the end of the day depends on the capacity of the investment business to reconcile all purchases and sales. You will thus get the same price at the end of the day, regardless of when you make your purchase. ETFs and unit investment trusts, on the other hand, trade similarly to stocks in that if a stock is selling at $90 or $120 at 9 o'clock in the morning and you want to buy it at that price, you may do so. Vanguard S&P 500 ETF, ticker symbol VO, iShares Score S&P 500 ETF, ticker symbol IVV, and SPDR S&P 500 ETF Trust, ticker symbol SPDY, are the 3 largest S&P 500 ETFs. You should have learned something beneficial from this video. Please let me know if I answered your questions about the S&P 500 if you found it helpful. If you learned something new and if there are any other personal finance topics you'd like to learn about in relation to dividend investing. Thank you for watching. I hope you have learned something from this video. If you like this video, do give us a like, subscribe to the channel, and comment down below. Thank you and goodbye.